Now we're going to look at the partial equity method for the year of acquisition. This method recognizes and records equity in the earnings of the subsidiary. In other words, dividends as it decreases in the investment account and income as increases in the investment account. But the difference between this and the equity method is that it does not recognize the excess amortization. So when we acquire this investment, we of course record an investment at what we paid and the cash that went out. When we get the dividends, we record a decrease in the investment. And when the company, the son company, in this case a subsidiary, declares its dividend, its investment for, try that again, when it shares its net income for the year, then our investment goes up and our equity in the earnings of this company goes up also. But at year end, we do not make an entry to recognize any excess amortization. We're given, of course, the information for our worksheet. We make the entries, our usual suspects, S, to get rid of the subsidiary's common stock paid in capital and retained earnings, beginning retained earnings. Right, beginning retained earnings as in up here. We get our assets brought up to the fair value at the acquisition date, and this being the plugged figure. The equity in the earnings of the subsidiary we've already recorded. We know we've recorded at $100,000. There, it's here also. We want to remove that. Investment in Sun increases here because we're going to get rid of the dividends declared, because we want to eliminate the dividends declared as you know what, we want to, yeah, because dividends declared are normally a debit. So we need to credit this in order to get rid of them. So I know it looks, you're thinking retained earnings because dividends declared really are close to retained earnings, but remember that they decreased retained earnings and we want to get rid of them or wipe them out, so we're just zeroing them out. If that's a problem, think about the fact that you have a debit balance here and you want to get rid of the debit balance, so you have to make a credit. And then the last thing would be to record the excess amortization. And then you put them all together just as you have before. You go across, you add and subtract across, but then go down to get your net income. Net income then moves to the statement of retained earnings. The result of the statement of retained earnings goes into the balance sheet for year end. And that's all that there is to that.